NVIDIA has earnings today, and instead of trying to predict if NVIDIA is going to explode higher or completely crash after earnings, I want to show you a completely different way to approach this stock. In this video, I'm going to show you how you can own NVIDIA, generate income from the shares that you already own, and protect yourself against some massive moves to the downside, all at the same time. And what I really like about this strategy is that you don't need to predict exactly what NVIDIA is going to do next. If it goes up, you can make money on your shares. If it trades sideways, you can potentially generate income. And if it crashes, you have protection built into the downside. This is a strategy that a friend of mine is currently using. Over the last 11 months, he's grown his portfolio by 12%. And once he explained the strategy to me, it's actually way simpler than it sounds. There are really only three pieces. One, you have to own the shares. Two, you have to buy insurance. And then three, you have to have a way to generate income. Now, let me show you exactly the way this works. Now, let's use completely hypothetical numbers here just to keep the math simple. While I'm making this video, NVIDIA is currently trading at 210, but in this example, we'll say that NVIDIA is trading at $200 per share. The first thing that you need to do to pull off this strategy is go out there and buy 100 shares of NVIDIA, which is currently right now close to a $20,000 investment. Now, why 100 shares? Because one standard options contract represents 100 shares. And what that is going to allow you to do is sell one covered call against your position, which is very important and critical to the strategy. Now, at this point, though, you will be just a normal NVIDIA shareholder. If NVIDIA goes from $200 to $220, then you make $20 per share. That's great. But if NVIDIA gets absolutely destroyed during earnings and it falls from 210 down to 160, then you also lose close to $50 per share. And that could be close to a $5,000 loss. So the first thing that I want to do after I buy my 100 shares is I want to put some insurance on that $20,000 investment. And this is where a protective put comes into play. For all of you that trade small caps out there, this is going to be very similar to a stop loss, but it's actually even better. So what my friend will typically do after he buys his 100 shares is he will buy a put with an expiration date roughly 1 year out. So if today's August 26, 2026, he'll buy one that expires August 2027. And he will make sure he buys that put at a strike price below his entry price on the stock. So let's say for this example, we bought 100 shares of NVIDIA at $100. Then maybe I buy a put at $190 that expires 1 year out. The easiest way to understand this is to think of that put as an insurance policy. That contract will give me the right to sell my 100 NVIDIA shares no matter what at $190 per share all the way to the expiration date. So let's imagine the absolute worst case scenario. NVIDIA completely falls apart. They miss earnings and they fall from $200 per share down to $150, or maybe they fall down to $100. And if I only own the shares, I'd be down close to $10,000 in that position. But now I own this $190 put, and that's my downside protection. Now I don't necessarily have to exercise that put. As NVIDIA falls, that put will generally become more valuable. So I could potentially sell the put itself for a profit and use that money to offset some of the losses on my NVIDIA shares, or I could choose to sell my NVIDIA shares at 190. Either way, the concept is the same. I am buying insurance against a major collapse. Now, when I first heard this, one of my immediate questions was, well, why wouldn't I just put a stop loss at 190? And there is a massive difference. A stop loss does not guarantee that you're getting out at 190. Imagine NVIDIA closes today at $200, earnings comes out after hours, something horrible happens, and tomorrow morning NVIDIA gaps down and opens up at $140. Your $190 stop can't magically sell your shares at 190 if nobody is buying them there. You might end up getting filled around 140. The put is completely different. As long as my $190 put is valid, and it's valid all the way to the expiration date, I still have the right to sell those shares for 190. So a stop loss basically says, if NVIDIA trades down here, try to get me out. The put says, I have the right to sell my shares at this specific price. That's why I think of the put as actual insurance. Now, step 4 is to sell a covered call. Now we have another problem. That insurance that I just told you about, that's not free. A 1-year protective put is going to cost you money. But what you can do is use your 100 shares that you own to help generate income and offset some of that cost. And you can do that by selling a covered call. And there are two really important things about how you can do this. Number one, you'll typically be looking at a call roughly 1 year out. And number two, you're going to be looking to sell a call at a strike price that is above your entry price on NVIDIA. So let's go back to our example. Let's say you bought NVIDIA at $200 and maybe you sell a 1-year $240 call. Someone pays me $20 per share for that contract. Remember, one contract will represent 100 shares. So 20 times 100 shares. That's a $2,000 premium that I get to collect up front. Now I've generated $2,000 from shares that I already own, and that money can help offset what I just paid for my protective put. But obviously there's a catch. By selling the $240 call, I have agreed that my 100 NVIDIA shares can be sold for $240 if I'm assigned. So imagine NVIDIA absolutely crushes it. The stock goes from $200 to $300. Without the covered call, I'd make $100 per share and a total gain of over $10,000. But because I sold that $240 call, I've capped my upside while that call is still outstanding. So if I'm assigned, my shares are sold for $240. So I'm making a trade-off. I'm basically saying, look, I'm willing to give up some of the massive upside in exchange for getting paid cash today. Now, step 5 is you don't necessarily need to hold the call for an entire year. Now, this is probably my favorite part of the strategy. Just because you sell a call with an expiration 1 year away does not mean that you have to sit there for an entire year waiting for it to expire. You can actively be managing that call. So let's go back to our example. Let's say NVIDIA is $200. I sell a $240 call for $20. I collect $2,000 in premium. Now imagine NVIDIA starts falling and it goes from 200 to 190 to 180 to 175. As the price of NVIDIA gets further away from my $240 strike price, that call will generally become less valuable. So maybe that same call I originally sold for $20 is now only trading for $8. And this is where you have to remember something really important about selling options. You don't have to wait for the contract to expire. You can buy it back. So let's think about the numbers. I originally sold the call for $20. I collected $2,000. Now that the stock price has dropped on NVIDIA, I can buy that same call back for $8. That only cost me $800. So $2,000 collected minus the $800 to buy it back equals a $1,200 profit on the covered call trade. It's basically the opposite of buying a stock. With a stock, you're usually thinking buy low, sell high. Here, what we're doing is selling high and buying back low. And once I buy that call back, the obligation is gone. I still own my 100 NVIDIA shares. I still own my protective put, but I no longer have that $240 call capping my upside. So now my upside is infinite. Now for step 6, what happens if NVIDIA rallies again? So let's make this even more interesting. Let's say that you bought a call back when NVIDIA was 175. Then NVIDIA starts recovering to 180 to 190 to 200 to 210. As NVIDIA starts to rally, the call premiums can become more attractive again. So now I potentially have another opportunity. I can sell another covered call above my entry price and collect another premium. Maybe this time I sell a $250 call. I can collect another chunk of cash, and if NVIDIA falls again and that call becomes significantly cheaper, I may be able to buy that call back for a profit too. Then NVIDIA rallies again and I can potentially sell another call. That's where the active income component of this strategy becomes really interesting. You don't have to collect one covered call premium per year. You can look for opportunities to sell calls when the premium is very attractive, buy them back cheaper as NVIDIA falls, then potentially sell another call when NVIDIA recovers. You are essentially trying to monetize some of NVIDIA's big price swings while continuing to own the underlying shares. Now your next question may be, what if NVIDIA falls? And this is where I think the whole strategy really starts to click. If NVIDIA falls, obviously my 100 shares, they lose value, and that's bad. But look at what's happening around those shares. My protective put will generally become more value as NVIDIA falls, and that's helping offset some of my stock loss. At the same time, the covered call that I sold will generally become less valuable as NVIDIA's price goes down. That's also good for you because you may be able to buy it back for less than you sold it for. So let's play it out. When NVIDIA falls, your shares lose, but your put can become more valuable, and a short call can potentially become more profitable to close. That doesn't mean the overall position can't lose money. It absolutely can. The point is that we've built out multiple layers of protection around those 100 shares. Now, what happens if NVIDIA goes up? Let's say NVIDIA goes the opposite direction. NVIDIA starts ripping to the upside, then that's great. My 100 shares are appreciating, but if I have an outstanding covered call, eventually that call starts limiting my upside, and that's the sacrifice. If I sold a $240 call, NVIDIA goes to $300, I don't necessarily participate in that entire move to the upside if I'm assigned. And that's okay for someone using this strategy, because the goal is not how do I make the absolute maximum amount of money if NVIDIA doubles. The goal is how do I generate a solid return while controlling my risk. You're sacrificing the big home run so that you can constantly hit singles and doubles. And the final scenario is, what if NVIDIA chops sideways? Let's say NVIDIA doesn't really do anything. It just chops around. Maybe it's $200 today, and months from now, it's still around $200. My shares haven't made much money, but I may still have opportunities to generate income from selling covered calls. Time decay generally works in favor of the option seller But now remember, your protective put that you bought to protect you to the downside is also losing time value. So there is a cost associated with maintaining that insurance. And that's why the covered call income is so important. I'm trying to use the income generated from my shares to help offset the cost of protecting those shares with the put. So if you want to remember this entire strategy, it's very simple. NVIDIA goes up, your shares will make money, but the covered call can eventually cap your upside. If NVIDIA chops sideways, you can potentially generate income by selling calls against your shares. And if NVIDIA crashes, the put will provide you with downside protection, and the covered call that you sell may become cheaper, potentially allowing you to buy it back for profit. And if all of this sounds complicated, here's the easiest way that I can explain. Imagine NVIDIA is a house. The 100 shares are the house. The put is your insurance policy. This is saying if a hurricane comes through, I want to make sure that my house is protected. And selling covered calls is like generating rent from your house. Let's say you have one room and you rent that out to a friend, and that's generating you income. You own the house, you insure the house against a disaster, and then you try to generate income from that asset while you own it. And that, my friends, is how you can own NVIDIA, generate income from the shares you own, and protect yourself against a massive move to the downside. And if you learned something from this video and you really like the strategy and you want to know all the stocks that we're currently using this strategy on, comment options down below and let me know, and I'll make more videos like this. See you in the next one.